Hello out there in cyber accounting land. Professor Ebert here to help you master it quick. In this session, we'll look at making financial statements. We're going to spend most of our time with 3 of the 4 statements. We'll look at the income statement, the statement of retained earnings in the case of a corporation. If the company is a proprietorship or a partnership, that statement is a little bit different. It's called a capital statement, but it's the same idea. And then the balance sheet. We're going to let the statement of cash flows go until a later date. The reason is it's rather involved, and we're going to use pretty much a whole financial accounting course to be able to do one. So most schools address that in the second course, so we'll do it in a separate session later on. The job of making the financial statements is made much easier for us if you keep in mind the jobs of the 6 different types of accounts. Now, first we'll look at the revenue account. You remember what the revenue account's job was. It was to accumulate how much revenue had been earned during a period of time. So when it comes time to do the income statement, the revenue account is one of the types of accounts that we're going to want. On an income statement, we're also going to need another of the type of accounts that accumulates activity, which is called the expense accounts. So when we make the income statement, we're going to call on revenue and expense accounts to help us out. Those are the only 2 we need. The other accounts will all get used when we make the other statements. Now remember, the job of the income statement was to show us the results of business operations during a period of time. So that calls for the revenue account, as we said, and the expense account, which is going to show us the different types of expenses that were incurred during the period. Once we put them together, we'll be in a position to see if the company had a profit or a loss for that period of time. To see how one works, let's suppose Bill's Auto Repair Incorporated did $600 of auto repairs during May and used up $1,000 of salary expense, $900 of rent expense, $500 of supplies expense, $300 of insurance expense, and $200 of utilities expense. We would get these, of course, from the adjusted trial balance. The income statement would look like the slide. From the income statement on the slide, we can see that the business had a profit or a net income of $3,100 for the month. This is because the revenue exceeded the expenses by that much. Had the expenses been larger than the revenue during May, there would have been a loss. That slide showed us how a service company would make an income statement. Retail type companies make theirs a little bit differently, which we'll see in another session. But they were all doing the same thing. They were comparing the amount of revenue earned in a period of time with the amount of expenses that were incurred during the same period to see if there was a profit or a loss. Now, there was a reason why we did that statement first. When we do the second statement, we're going to need to have the outcome from the income statement because it's going to be used when we do the retained earnings statement, which we'll do next. The second statement that we'll make for Bill's Auto Repair is the statement of retained earnings, assuming that Bill's Auto Repair is a corporation. The way that statement starts out, the heading indicates it covers a period of time, like the income statement did. The purpose of this statement is to show how the retained earnings balances change during that period of time. All right, so now we're going to call on one of the other accumulator type accounts to help us with this. The dividends account, if you remember what the job of that account was to accumulate for us how much dividends had been declared by the company during a period of time. Once we have that information, we can use it to make a retained earnings statement along with the outcome from the income statement. So the retained earnings statement will always be done second after the income statement. Now, as you can see, Bill's had a balance already there on April the 30th. Here's what that really means. If you see a beginning balance, that company has been in business for a while. If it was a brand new company, the beginning balance would be zero because there aren't any retained earnings yet. In this case, the beginning retained earnings was increased by the net income we had during the period, and then we called on the dividend account to furnish how much dividends had been declared, and you see it's $1,000, which is going to be a reduction to retained earnings. Net income is always an increase. A net loss would have the opposite effect. It would shrink the retained earnings down. But a dividend is always a reduction of retained earnings. So this is simply combining these amounts to see what Bill's ending retained earnings balance would be on May 31st. So why did we do that 1 second? Because we're going to need that information when it's time to do the balance sheet for Bill's. So far we have made use of revenue and expense accounts to do the income statement, the dividend account to do the retained earnings statement. Now, if you remember from our session on accounts, there were 6 kinds. The other 3 are the ones that are going to be used to make the balance sheet. So we're going to call on asset, liability, and capital type accounts, including that ending retained earnings balance that we got from the retained earnings statement. Now, those accounts had a different job. If you remember from the session on accounts, rather than accumulating how much of something happened during a period of time, those 3 accounts, assets, liabilities, and capital, had the job of showing you what was the balance on the last day of the period. In the case of assets, it was how much usefulness is still left in those assets. In the case of liabilities, it's how much debt is still owed for each kind of liability as of the last day. And the capital accounts will hold the key to seeing what the worth or the equity of the company is on that last day. We'll see that when we make the balance sheet for Bill's. When it comes time to make the balance sheet, one thing that'll help us a little bit is being able to identify an asset account from its title. Asset accounts are kind of the exception. The revenue accounts were pretty easy to pick off because they all said revenue or sales in the title. Expenses all said expenses except for cost of goods sold, which we're going to see in another session. Liability accounts are somewhat easier to identify. They'll say the word payable. Capital accounts are somewhat easier to identify. This is kind of the only exception. There's a bunch of different things that are all assets. Now, the ones I have listed at the top here are what are called current assets. That designation is used because they're either cash already or we expect them to become cash within a year from the balance sheet date. So accounts receivable will become cash when a customer pays us. Any kind of prepaid insurance, as you know, the part we didn't use yet is still considered an asset. It's going to get used up within a year, so that's why it's current. Inventory will turn into cash when we sell it, of course, if we're a store. And supplies we bought to be able to help us work without having to run out to the store if we run out of something. So the part we didn't use is still considered a current asset. We're going to use it up within a year in all likelihood. Now these guys are also assets. All of your PP&Es, equipment, truck, furniture, building, anything like that, land, will be considered a long-term asset because it's going to take longer than a year for it to turn into cash. They'll always be stated at the net. In other words, less the accumulated depreciation balance. The reason that's done is to show you how much usefulness we think is still left in that PP&E asset as of the balance sheet date. The other thing you'll see down here, the company might have financial investments which don't mature until after a year. So they might have a 5-year treasury bond, something like that. That would be considered in the long-term investment section, along with any intangible assets they may have. That'll include things like if they have the patent on how to make something, if they have a copyright to a photo or a slogan or something like that, if they have a brand name, registered trademarks of different kinds, distribution licenses of different kinds are all types of intangible assets. So they're all going to get used on the balance sheet, and again, their job is to show you how much is still left in them as of the balance sheet date. On a balance sheet, we're also going to need to make use of the liability accounts. Now, when we put it together, you'll see the total of the asset accounts is going to be explained by the total of these guys plus the third type of account that we haven't used yet, which we'll talk about in a couple of minutes. But first, a little bit about how to identify these accounts. Much easier to do. They'll use the word payable in the account title in most cases. The one that doesn't is the unearned revenue account that we saw from our session on adjustments. Remember, unearned means that we haven't done the work yet. That's why it's a liability. But all the other ones that I can think of will all say the word payable. Accounts payable, of course, are going to have to be paid very, very soon. So they would be considered a type of a current liability. In other words, due within a year from the balance sheet date. Along with salaries payable are probably going to be paid in the next pay period or so. Taxes payable might be current. In most cases, they will be. They'll probably be due by the end of the quarter or possibly early in the next quarter. Just remember, taxes payable can be long-term. Now, that's a little bit advanced for what we're doing, but a deferred tax liability means the taxes are not going to have to be paid until after a year. Note payable is a different situation. If we've got a note that we're making periodic payments on, 12 of those payments are going to have to happen in the next 12 months. So the principal that's going to be repaid on the note because of those payments is grouped together and is referred to the current portion of the note. So that's up here with the current liabilities. What about the rest of it? Down here with the long-term. Long-term liabilities don't have to be paid until after a year from the balance sheet date. So the rest of the mortgage or note that doesn't have to be paid until after a year would show up there, along with one type of long-term liability that companies can use to raise money with is to sell bonds to investors. And if they do that, you'll see a balance in bonds payable, which is a type of a long-term liability. Now, the idea of splitting assets and liabilities between current and long-term is called making a classified balance sheet. The reason why this is done is one way to assess the company's financial position is to see how liquid the company is at a given time. Liquidity speaks to the company's ability to meet current debts. So all these guys up here would have to be paid using current assets. So if the company's got $10,000 of current assets and only $3,000 of current liabilities, they are very liquid. In other words, they have a lot of working capital available to them at that time. Where the fun starts is when it's the other way around. If the company has $3,000 of current assets and then $10,000 current liabilities, they're broke. So a nice way of saying broke is they are illiquid. They cannot meet the current obligations. Another aspect is the company's ability to meet all kinds of obligations is called solvency. So solvency can be assessed from a balance sheet as well, along with how much the company's net worth is, which is the part we're going to look at next. The final type of the 6 accounts that we're going to use is the equity type of account or capital type of account, which will vary a little bit depending on how the business entity is organized. If the company is a corporation, there'll be 2 accounts in that section. That retained earnings balance that we got from doing the retained earnings statement is going to be used here. Also, the capital stock account is sometimes called common stock, although there's actually common and preferred stock, which we'll see in a future session. The reason it's split out like that for a corporation is because the shareholders actually own all of the equity. So if you had shares in a public corporation, you actually own little tiny pieces of both of those things. The company wants to be able to tell the difference between how much capital has been generated by the company itself, which is really what retained earnings is. Retained earnings is profits that have been kept in the company rather than paid out as a dividend. The other way that they can raise capital is to sell shares of stock, of course, which is tracked in the capital stock account. So that's unique to a corporation. If the company is organized as a proprietorship, it's very easy. The owner has a capital account, and that's the sum total equity of the business at that point, whatever that balance is there. A partnership or an LLC with multiple members, each partner in the partnership or member in the LLC will have a capital account of their own, which will be summarized at the bottom. The job of these accounts, as we said, is to show you how much equity exists on the last day of the period. So when we go to make the balance sheet, we're going to take all the asset accounts and add them up, see how much they are. The total of the liability type accounts plus these guys here should be equal to the total of the assets. In other words, one of the jobs the balance sheet has is to explain how the company came to get the assets that it has as of that last day. So to make a balance sheet for Bill's Auto Repair Incorporated, we'll need to know the ending balances at May 31st, 2001X in all of the asset, liability, and equity accounts. Suppose that they were, as shown in this slide. These would come from the adjusted trial balance. Here's how we would use them to make the balance sheet for Bill's Auto Repair Incorporated. The total of the assets has to match the total of the liabilities and equity, or something is big time wrong. In cases where the totals don't match, it could be just an addition mistake somewhere, or it might be that the retained earnings amount is not the ending amount that was there on the last day of the period. See how it explains the sources of the assets? On that 5/31 date, Bill's Auto Repair Incorporated had $12,000 worth of assets in total. How they came to get them was they used liabilities or debt to get $2,900 of the total, and they used equity to get the rest. Now, the balance sheet is very, very important to an investor or a lender because, among other things, they're interested in seeing how much debt that company is using at a given time. And you can see right now, Bill's Auto Repair is not really using that much debt. That's about $3,000, which is about 1/4 of the total. So in other words, they got about 3/4 of their assets by using equity and about 1/4 by using debt. So could Bill's afford to take out another loan? Most likely, yes. If it were the other way around and the debt was 75% of the asset total, then the bank would reject them because the bank would be afraid that they wouldn't be able to be repaid on the loan. Investors are looking at that too to decide whether they want to buy shares or buy bonds possibly that are issued by the company. So the balance sheet, very, very important financial statement, and it's done third after we have the ending retained earning balance, which of course got used when we were making the equity section. See how it works? So to summarize, 3 of the financial statements that we looked at should be done in the order that we show here. Income statement shows results of the business operations during a period. We used revenue and expense accounts for that. Do it first because we need the outcome to do the second one. Statement of retained earnings. Statement of retained earnings, we used the dividend account to help us do that. And it showed the changes in the retained earnings balance during a period of time. We did that one second because we need the ending retained earnings to be able to do the third, the balance sheet. The balance sheet showed us, as we saw, the sources of the assets. It also showed us financial position, the company's liquidity and solvency, and it also showed us how much the company's net worth was at the end of the period. Now remember that net worth is a book net worth, not necessarily what somebody would pay to buy the company. See how it works? Good. This is Professor Ebert. See you next time.